Housing's not like that. It's a slow turn. It takes a long time for that to actually come to fruition. So you do get warning shots.
Right.
But those warning shots may only give you 2 or 3 months. So if you're not getting an update, but say once a quarter, or maybe you missed the last one and now you're coming every 6 months, by the time you find out that there's been a shift in the marketplace, you're in it.
You're listening to the AZREIA Show. If you're looking for quality real estate investing information that you can trust, you've found it. Stay tuned and join the tens of thousands of members that have already benefited from AZREIA, your home for education, market information, support, and networking opportunities that will advance your real estate investing career.
Good morning, good afternoon, good evening, AZREIA and our Arizona family. Thank you for being here for another episode of the AZREIA Show. On today, we have our very special guest, Tina Tamboer of the Cromford Report. She's our Senior Housing Analyst. But before we get to Tina, we always got to give acknowledgement to our Executive Director, Mike Delpreet. How are you doing, Mike?
Wonderful, wonderful. Excited for today.
Okay, good. So we're going to be talking about the market update. We're going to be talking about what's going on in the market locally. We're going to talk about interest rates, unemployment, housing. So you guys, you really need to pay attention and be well abreast of what Tina is going to be sharing with us on today. So Tina, How are you? Welcome.
Thank you. Thank you for having me. I'm great.
So how did you gain the title Senior Housing Analyst? I'm sure you had to know about the market for years and years and years, right?
Well, I've been an analyst for 30 years. So I moved here to Phoenix in 1993. That's where it all started with a large title company. And I was in sales for 10 years for title insurance. And then I joined Michael Orr with the Cromford Report, who's a mathematician and analyst in his own right. And we've been working together now for 13 years. Let's see, awesome. I started 2011. Wow. So at the beginning, January 1st, 2011. So I'd say that because not only have I been watching Phoenix real estate specifically in my capacity as an analyst, but I've also lived it as a salesperson during the bubble and the crash. That dual experience for me, I believe, helps a lot of our subscribers and our clients put the stories and the experience with what's happening in the numbers.
Perfect.
So that's a big jump. Title sales.
Yes.
To data.
Well, actually went from data to title sales, and I cried for 3 months.
Okay.
Yeah, it was real. That was the hardest thing. I was always an analyst first, and I learned sales and how to talk to people.
Got it. Okay. So how'd that happen? Obviously, you said 2011, so it was after the crash. The market was probably... It was steady. It was probably like stale.
The bottom of price.
Yeah, it was at the
bottom of price at 2011. That's when things started to turn. So unemployment, well, the bubble started in 2005 and then started to show weakness in 2006. And then, of course, 2007 and 8 is when the crash happened. And then unemployment hit. That was mostly tied to the real estate industry, frankly. That's where a lot of our industry was: tourism, real estate, construction, low-end call centers, which were retail, and all of those went down all at the same time. And so we had massive unemployment, but it peaked in 2010. So right around 2011, and I had been working in the title insurance industry. I had gone through 1, 2, 3 logos in a year. Okay. So,
meaning company to company.
No, I didn't move. My first company sold, and then the company it sold it to, Land America, if you remember them, they went down the toilet in less than a year due to the bond market.
Got it.
1031 exchanges is what was their iceberg that they hit, if you will.
Okay.
And then they were purchased by, the escrow and title was purchased by Fidelity National Financial, which changed the name to Lawyer's Title.
Got it.
So those are, I didn't move.
You're still there. Yeah,
I just kept getting a uniform change.
Yeah.
So by that point, that was like 2009, I decided that going through that experience and not knowing what the numbers were, because I was in sales and not really having a good grip on how to prepare and respond, we were always in this reactive mode. We were reacting to it, not preparing for it. And that's what put me back into analytics because I'm like, I do not, the PTSD is strong from that. And I do not want to navigate another uncertain time without having the data and the analytics to at least guide us through like headlights in the dark.
Right.
We can't tell you where the end is going to look like, but we can tell you what's around the corner.
Yeah. So did Michael, like, how'd that relationship happen?
Interestingly enough, in the 90s, when I was an analyst for a large title company, I met Tom Ruff with the information market, and we became friends just professionally because we would buy his data, and then we lost touch. And when I decided to get back into analytics, I called up Tom because I was going to be independent, right?
Got it.
And as we were coming in, we had a meeting at Starbucks, and in walks Michael Orr. And at the time, Mike had launched and he was speaking and he had his product out and he was, getting hundreds and hundreds of people at these speaking events. And so he walked in, I'm like, oh, I'm like,
cool.
Oh my God, look, we're in the same room. And then he comes and sits at our table and I'm like, what?
Oh,
So
wow.
apparently Tom Ruff and Mike Orr are very good friends. And
Okay.
so my introduction to Mike was Tom saying, hey, Mike, this is Tina Tamboer. She's one of us. From my friendship in the 90s when I was in
That's like
20.
a mafia term.
It was crazy. I know. Next thing you know, Mike was like, great. And then he started just,
Cool.
he's like, oh, you're going to be coming into this? Let me give you all of the stuff that I have no time to do.
Okay.
And so that was the beginning of it. And then the Cromford Report was really part of the MLS for a long time. And there was a decision that was made in 2012 to not have the Cromford Report a part of the MLS services. And so we went independent.
Okay.
And so we've been independent now since 2012.
So share with us your relationship with our founder.
Oh, yeah, Alan. So Alan had a relationship with Michael Orr, and he was coming. Michael was presenting to the AZREIA group for, like once a quarter or so for a while, and they had a friendship. And so when Michael got too busy, then Alan started giving me a chance. And so, but in 2011, I was really green.
Okay.
Yeah, so nobody knew who I was back then, and Alan continued to give me that platform to hone my skills, learn from the investor population as well, and kind of come up with different angles. Because every time I do a public speaking in-person event, I would get feedback on questions that we may not have answers to at that time, and so that was great for the creativity of this new endeavor I was on to create charts that work for investors as well. So that's when we created a lot of our flip. I created the flip map, so you can look at a map and say, oh, okay, here are all of the properties that were bought and sold within a certain time frame that you can control, that you can see who bought it, you can see what they paid for it, what the final sale price was, how long they held it, and what the percentage gain is versus the dollar gain, and all of that color coded on the map. So that came directly from my experience
Cool.
talking to AZREIA.
There's a lot there, though. So your data, my assumption is you're probably more introverted, maybe? I'm not saying you are.
hybrid now.
Yeah, but no, in that time, though,
Yeah.
like Michael's like, I'm busy. You got to go take over AZREIA and do the presentation. So you're thinking, you're mining in the data, creating everything. Then you got to present it on stage. And then you got to present it to maybe like a new group versus agents, like you said. So there's a lot going on there. You had to
There
adapt
was
to.
a lot of change. I
Yeah.
mean, I had been in sales for 10 years, so talking
Okay,
to people I could do, but the topic was, I don't want to say different for me because I did have a basis to work with, but it was definitely a growing experience to be able to take people's theories, if you will, like, hey, they'd come to me and say, what do you think about this? I think this is happening, blah, blah, blah. And I'm like, well, let me go look at that and see if that theory tests true.
Right.
And that's, I think, what we do most of the time is we take a lot of the experience that people have on the street and we often tell them that they're right. But sometimes we might be like, well, you're right, but you're not like, it's not extreme right. It's like this is happening, but it's not something to be worried about, or this is happening, or it's like a seasonal thing, or sometimes it's this is happening. You better watch out. You know?
Awesome. So on that, let's talk about the importance of a market update. You know, especially we hold a market update. You come every other month here at AZREIA at the venue 8600, which we really appreciate. So what's the importance of an update? Why should an investor attend, and why should they listen?
Well, essentially, you don't want to be caught off guard. And the wonderful thing about housing, the difference between housing and, say, the stock market, it's the difference between a big oil tanker turn and a speedboat. So some of these markets, like crypto, can turn on a dime, stock market can turn on a dime, and you can get surprised by that, right? Or maybe you're not, but you only have a little bit of notice to make your choices. Housing's not like that. It's a slow turn. It takes a long time for that to actually come to fruition. So you do get warning shots.
Right.
But those warning shots may only give you 2 or 3 months, right? So if you're not getting an update, but say once a quarter, or maybe you missed the last one and now you're coming every 6 months, by the time you find out that there's been a shift in the marketplace, you're in it. You're already feeling it. And you don't want to be like, oh, my rental's been vacant for a month. I better go to an update.
Right.
You don't want to be like that. You need to be dropping your rents before you see vacancies.
And you made it during COVID, which you were here for us at AZREIA on Zoom and everything, keeping all our landlords up to date. Was something that stuck out to me was you showed a timeline, because the market was like, we're gonna the doom and gloom crashing, which we all felt crazy, some crazy at that time. No one knew. But you said something like, you were saying, hey, the last time we dropped, it took like 6 or 8 months or something.
Yeah.
Going to your point. And so you're saying, hey, we're not even there yet. Am I right?
You have time.
Yeah, you have time.
You have time. And none of the math at the time was supporting a crash. And that kind of puts me back to last January, too. Remember when Goldman Sachs came out and they predicted that Greater Phoenix would see a 2008 style price crash. I mean, if that doesn't send shivers through every investor who survived that time frame, or excitement. I mean, one of the two, like, whoa, this is going to be amazing. Or, oh my gosh, I've got homes, like, all of that. But to be able to come in and say the math really doesn't support what Goldman Sachs was saying at the time. And we lean into what we know. And it turned out that Goldman Sachs came out in August and said, oh, yeah, we don't believe that anymore.
Right.
And I'm like, thanks a lot. So if I had based my investment decisions on what Goldman Sachs had predicted, I probably would have lost out on,
That's true.
Unless, they used it and been like, hey, you better sell to me now. I mean, sometimes they can use that, but you can use it with the confidence that I'm going to buy this, and the numbers are telling me that prices are going to go up. So I'm going to go with what my numbers in my area say, and not necessarily what Goldman Sachs says, unless the math coincides. And so that's where I believe we gave a lot of investors the confidence to continue to run their flip models, and in a different market, a different seller's market, but a seller's market nonetheless, which is the only kind of market that sustains that type of activity.
In regards to interest rates, let's kind of go down that road. What are you thinking? What are you seeing? Because there's a lot of different speculators out there saying, hey, interest rates got to come down. It's going to take massive unemployment for interest rates to come down. Kind of what are you thinking, as a local professional in this market?
I can tell you that I feel really bad for housing analysts that are asked every week what interest rates are going to do, because they've been wrong so many times. And we've often said at the Cromford Report, we don't predict rates. We let other people be wrong about rates. You have to deal with the rate you have today. Is it reasonable to expect? So instead of doing predictions, I like reasonable expectations. So in the last presentation, we went through where the arguments lie in the media right now. So I just almost finished watching a debate between two analysts throwing out every single analytic you can imagine to try to figure out which way rates are going to go, which way prices are going to go, demand, supply, all of that stuff. And I was loving it, but I also realized that most people probably turned that off really early because they're like, I don't know what you're talking about. But for me, I'm like, this is exciting. But as far as where rates could potentially go reasonably, I think it's reasonable to expect that these rates will not be at these levels forever. Okay. Now, garnering when they're going to come down means that for flip investors, it's probably not going to happen during their hold time.
Whole time. Okay.
Yeah. I think we're in a very gray area of uncertainty right now. Uncertainty for sellers, uncertainty for buyers, but uncertainty in general, they don't like to move. Nobody likes to most people don't like to make a difficult decision or a big decision in this cloud of uncertainty. Right. However, there are going to be people who have to, that no matter what, that is their certainty. Like, I am certain I have to do this. I'm in distress. I'm, going through divorce, whatever it is. And so those are the environments you have to work within. But if you're going to hold it for, say, 3 to 5 years, you're going to sell somebody who's going to hold it for 3 to 5 years, then I think that those rate buy downs give people enough hedge.
Okay.
And so I think if I were flipping, I would be budgeting in the rate buy downs.
It's funny you say the seller carry or the buy downs and everything. So we're actually negotiating a seller carry right now at 5.5%. So are you noticing in your data like more creative deals coming through, like seller subject to, seller carry, with lease options?
We don't get those in public record. What we get is whatever's recorded.
Got it.
So if it's not recorded, we're not going to know about it. But we do have we have a finance type. We're not seeing an increase in seller. They do have to record if it was a, seller finance and things like that.
Yeah, it's the title switches.
So we're not seeing an increase in bartering. That's actually an option as well.
Okay.
We're not seeing a huge increase in seller financing, but they are there. We are seeing a lot of FHA. FHA is the one thing that's actually you can see the growth rate, especially under 600,000.
Under 6.
So why are you thinking that growth margin is there with FHA?
FHA did 3 things. The first thing they did was they increased their loan amount, and so that pushed them into that 500,000 to 600,000 range. First of all, they also allow more concessions for somebody who's getting FHA. They allow more concessions for sellers often.
Okay.
Compared to conventional, and more dollar amount. And then the rate is lower. The rate usually runs about a quarter to a half point below.
But isn't it still unaffordable at some level? Like being first-time home buyer.
When FHA went above 6.5, that we really saw a big tightening there. Because again, the sellers might be able to buy down the rate, but it's about whether or not they can buy down the rate with the acceptance of FHA, with the amount of money that they're allowed to. And so that's something you have to talk to a lender about. I'm not as familiar with all of the guidelines under FHA, but that's the one thing, if you're looking for any major increase in trends, that's what I've been noticing.
Well,
it's funny because just 2 years ago, flippers didn't want to sell to FHA buyers. Now it's like, where's the FHA buyers?
Oh, FHA has come out every single time the housing market has had an issue. So remember that back in 2008 and 9, but specifically when they did the first time home buyer credit, FHA came out with the, what was it called? The 203K?
Yeah, rehab loan. Yep.
Yeah, which was the renovation loans. And that was an FHA product. It was a pain in the butt for every lender, but that was where it was at. That was what was going to get a first time home buyer into a home that had been literally trashed,
destroyed,
and just annihilated. And it also helped a lot of the builders. I don't know if you guys remember this or not, but the flippers were working with the builders, and the builders would take the buyers and give them a tour of their stuff, their cabinets and all of that, their upgrades. And so they would go in and the buyers would pick out their cabinets, they'd pick out their carpet and their paint, just like it was a new build. And then the builders would come in and they would do it according to FHA. So it was like this whole thing.
Wow.
And
I love that. That's being creative and always adapting is something we have to do here.
This market is the when I say this
Yeah.
market, I mean the housing market specifically is, in my opinion, the fastest responding industry to any change, government wise or market wise. You have thousands and thousands, tens of thousands of squirrels all working in their own best interest. And
Yep.
you know, and what's so amazing about this industry is that when somebody finds a solution, they share it. And then it gets implemented
Yeah,
like
rolls
boom,
out.
like that. And I love that about our industry. I mean, it's for good or bad sometimes, but I love that when COVID came out, this industry was really fast to everybody. Within literally days, everybody was wearing masks. They were doing showings with like the hand sanitizer was out. We're like, we're doing business, people. This
You
is
gotta
not
keep
gonna.
it going.
We're gonna. I know. They're like, they got all the booties on their, you know, everything. They're sanitizing, but they were out there implementing changes to make people feel better about buying homes. And the people who did that, the realtors and everybody who did that, actually did their buyers a favor, because now if you bought during the COVID shutdowns, you did very, very well.
Yeah. Very. Yes, you did.
Yeah.
Congratulations to those that did that.
I know. Yeah. I mean,
That was
despite all
scary
the
to do
fear,
that. Yeah.
and there were a lot of scary things, but you know what? The buyers knew. The buyers knew right away. If you had been searching for a home for the previous 3 months or whatever before COVID, and all of a sudden you see all these Airbnbs come on the market and they're in good shape and they come with furniture and they're, you know, well priced. They're like, I don't, virus or no virus, I'm going to
getting
go
that.
get that house.
And it's not only the retail buyers, but just as you probably both noticed, it's a different, when the market's changed, a different type of buyer comes in, right? Like over the last so many years, it was that, hey, just learned about real estate, I can make some money. You know, they say, the janitor's a fix and flipper now, right? So we hit that stage. And I remember when everything crashed in 09, 10, it was a different type. It was like China, Australia, California, Canada. It was just that savvy investor that knew what was going on and they weren't scared, you know?
Yeah, but at the same time, there was a little different activity going on with the dollar then. So what happened with the Canadians specifically, Canada came in and forced,
Yes.
mainly because the Canadian dollar came in even with
Stronger.
we
true.
were dead even. So for them, everything was on sale. Like, this is amazing.
Super on sale.
We don't
Yeah,
know
like,
when
double.
this is going to happen again. So they came in, and a lot of Canadians bought Maryvale homes. I mean, how can you turn down a home that was literally less than what your car costs?
Literally,
land,
20, 30 grand block
You're getting
home.
it for less than what it would cost to build. You're getting it for essentially land value. I mean, I remember seeing 25,000 for a full-blown single-family home in Maryvale.
So what do you think about what's going on? What's going on today? Like, what are your thoughts?
I don't think we're going to see that.
So yeah. Well, there's still
We're
people.
just going to reminisce.
People are still predicting that type of stuff, like the doom and
But
gloomer.
Yeah, of course.
Yeah.
But the numbers don't support it.
Got it.
So that's why, you know, you have to have the numbers. In fact, if you looked at just what's under contract, you'd be like, this, you know, the level of activity is very similar to 2006, which, you know, triggers all of our PTSD. But you have to remember what supply was back then. Supply was at, like, we were building way more than the population had been growing. We had a lot of builders stuck with vacant homes. We had 54,000 at our peak in the MLS. That would be, if we had, there's nowhere where are we going to get that?
Yeah.
We don't have that kind of vacancies now because we haven't been building to accommodate the population growth for a long time.
So what are your thoughts? How do you think, as recently we saw the ADUs are able to go forward now?
Yeah, that's nice.
It's not, and co-living, that whole, like, not so much Airbnb, but like workforce housing, like pad split that's out there.
Yes,
what do you think
I've heard about, where they're taking like 3 bedroom, 2 baths and converting them the same footprint into like 5 bedrooms and a kitchen or something like that.
Yep.
I've heard of that. I think what's happening with things like that, when you start consolidating, putting more people into one rental, when at the same time you're seeing your build to rent single family homes are coming on the market, we are starting to see a shift in rentals right now. And we have seen a pretty big increase right after the Super Bowl, but it was an increase that had been happening prior to the Super Bowl. But a lot of people put their long-term in a short-term rental and then went back to long-term after. And so we are at, I've only been tracking rental inventory since 2018, but we are at the highest we've seen and it continues every month to be a little bit higher. And what we're seeing for the first time since May is we've started to see those asking rents come down.
Okay.
At the same time that supply line has been rising, and it's coming down in both the median asking rent and the dollar per square foot as well. And for the first time this last September, we saw the median rent drop below 2,200. So I've had literally twice yesterday, I had property managers call me, and they never call me.
Okay.
And they're like,
That's good to know.
you know what's happening in the rental market? Like, we have vacant rentals all of a sudden. This is weird. So I think what we're seeing is a consolidation, or not a consolidation, but two things happening where you have the build to rent single family that were being built for the last 2-3 years is now done. Like, they're coming on the market and they're directly competing with single family rentals.
Okay.
At the same time, you have the pad splits that are consolidating your renters. So instead of having 3 people in a 1,400 or whatever square foot home, you have 5, which means that now you have 2 people extra in that place that would have been renting your 2-bedroom, right? And so that it's a household formation thing. So when you see household formation shrinking, people moving in together, that leaves a vacancy.
Right.
So 2 households in one, you're going to have a vacant listing. And so that's what I believe we're seeing in rentals right now. And those rentals, if they can't get a long-term or short-term tenant in there, they may turn into a property for sale.
Gotcha.
And so that's why we watch the rental market to see if that's where we're going to get our supply in the sale market.
Can it be just like a whole nother demographic, though, of someone that just can't afford even their own 2-bedroom? Like, can that be a part of why they're going to pass? So, like, would that necessarily bring a vacancy to a general landlord's 2-bedroom apartment?
Well, I kind of touch on that, Tina. I'm not sure, Mike, because we have higher incomes. So
Do we?
now,
That is true.
We have higher incomes
Yes.
in this state. So I don't see that dynamic where lower incomes, where people have to do a pad split. It may just be a functionality. People just rather be in this center core, and instead of paying for, I don't need this extra bedroom or extra space, I can co-live. I don't know.
Personally, then now we're just talking about my preferences. I'm going back to my 20-something person. If I was 20-something, if I don't get to pick my roommates, I'm not.
Yeah, it's tough.
That's not gonna work for me. Because especially for sharing a kitchen, I'm not cleaning up some stranger's plates. Doesn't work for me. I'd rather have one roommate in a 2-bedroom, 2-bath situation if it's comparable in price myself, and I'll drive. I don't care. But the thing is that I think more and more landlords now of single family homes are seeing they're accepting more creative situations. I know of at least one landlord that had 3 roommates in his 3-bedroom, 2-bath Tempe home, and had a parent who was responsible for the rent. And that home had a revolving door of roommates, but he never had to deal with it because he was the parent and I guess the grad student that was in there.
Okay.
Monitored everything. Yeah.
Okay.
Although
that was
they were
my
slobs.
thing with the co-living is, because the employment is high and the income is high, I just don't know where that dynamic is for that individual.
Yeah.
I just want to consistently do a pad split.
So the thing is that the argument that prices have to come down because we have to get into a place of affordability. When you look at the affordability numbers, a lot of these companies that put out affordability rates and stuff, they have to go off of the census, and the census data is only, even the feds, I looked it up, the feds only have data for Phoenix for 2021.
2021, yeah.
And so you can't use 2021 data for 2023. Let's face it, our incomes have been rising. And if you even just look at our employment reports, which are public, you can see that even the hourly wages have been growing at around 5% per year, which is about where we would be in housing if you take a long-term 20-year approach and say, okay, well, we were going up 5% per year from 2001 through 2003. And our median price then, if we had continued on that 5%, just slightly greater than the rate of inflation, right? And we continued all the way up till now, we would be very close to what our median cost for a home under 2,500 square feet would be. Now, I could always take that and apply it as well to first-time home buyer homes, which would be like 1,500 square feet or less, you know, but it would be the same. The line looks the same. So frankly, we're just slightly higher than where we would be if we had had a 5% annual appreciation rate. And now, if you look at our income since 2015, we have overall the average is about 4% a year, but in the last 4 years, it has been 5% a year. And so, and I'm looking at household incomes. I'm also looking at hourly wages that all support that our incomes are coming up. So what I'm thinking is that you could potentially see home values stagnate, maybe go up 3% a year, or a boring 5%.
Yeah.
But it would just catch up with that line, that long-term line, and then our incomes would come up and get us more into a range. I could see that happen within the next 2 years.
I like that because especially something Alan will always say at the market updates, it should be boring. You want that it's a little bit more predictable in a sense. You know what I mean?
Absolutely.
Knowing not much is going on. You know, be helpful with your flips, your
Yeah, I don't get much work that way.
yeah. There you go. That's true. There you go.
I know it was really boring in 2015 through 2018. I know. I remember joking around with Tom Ruff at one point that he's like, because we have to write these market updates. And he's like, "What are you writing about?" I'm like, "I don't know. It's boring. What are you writing about?"
thing.
He's like, "What we need is a good crisis." You know,
Yeah.
that was
Well, we
frankly
had
we
that.
did not
We
bring
got
that.
that for
It was
sure.
that was in 2015 and 16. So we didn't bring that into the universe.
Mm-hmm.
But the thing is that you know, when things are uncertain, then the analysts come out. When things are boring, that's when your clients are like, we don't need to listen to Tina right now. It's fine. But you just never know when things are going to get stirred up again.
You just
you
don't know.
and-
That's why you said be prepared rather than react. Did I say that right?
That's right.
Did
You
I
always
quote
want
you
to
right?
you always want to be preparing for instead of reacting to. So like let's just put it in last year, for example. The Cromford Market Index, I presented that at your meeting, that the Cromford Market Index right around February, March was weakening. And it's like, y'all need to watch this because
Yep.
there's a time when you want to just stop buying.
Right.
And if you ever see a double black diamond drop on the Cromford Market Index, that is your big red flag. Do not buy homes. Sell what you have and wait. Just sell it for whatever you can get for it and wait. And the time for that would have been between March and April of last year.
Okay.
Had people not bought homes, let's just say I did buy in June and I knew what I was doing because I was going to hold it for a long time. If you're going to hold it for a long time, it doesn't matter.
Right.
But if you're going to flip it, then you don't want to find yourself buying at the peak when you see that line coming down, because when you start to see it, it happens in the outskirts first. If it goes on for too long, it'll hit the inner cities, you know, the central cities. And so you have to watch that real quick because you don't want to be stuck with a home that you can't sell, and now you have to pay your payments on it. If you got a loan, you have to then pay for rate buy downs, you have to do fixes, you have to do all that stuff
All those concessions.
because you're in a different market at that point. And and if it's taking you 4 months to fix it up, you know, a lot can happen in 4 months. So right now we are seeing the Cromford Market Index weaken, and it's been for about 4 or 5 weeks now.
Okay.
And it's happening in just about every city except Cave Creek, which weird. We are seeing our outskirts like Maricopa and Queen Creek and Casa Grande and Goodyear are all now back in balance. Not buyer markets, they're just in balance markets right now.
Okay.
But with that, you have to watch as a flip investor your own individual city that you're working within to make sure that you would change your strategy to say, okay, well, here's a home that I don't have to do a lot to. I can turn it quickly and then I'll take another look, right? But you might, if you're looking at, say, a big rapid change in Chandler, which is our number one seller market, by the way, and you want to make sure you're still in a seller's market, but you start to see a big change in there, then you might be like, okay, well, maybe I won't take a 4-month remodel.
Well,
know.
I have a story like even with my wholesale hat on, as a wholesaler, you might be listening and saying, "What do I need to know?" All it's changed my life listening to the market update just within my business. Dude, I remember Alan it was years ago. It was at that point when where houses were creeping up on 200,000. So it's probably a little while ago, right? And what do flippers do or retail buyers do when it starts to get unaffordable, right? They shift to condos or townhouses. And then who follows them? The flipper follows them. Then who should follow them? The wholesaler should follow them. So once he said buyers are shifting over, I just next day turned all my marketing off to houses and turned it all onto condos and townhouses. And then immediately I did like 3 wholesale deals within that next 2 months just on those lists to condos. There's so many ways you could take advantage
And I'm
of the
telling you
market
what, I never underestimate how one small change in policy could
update.
turn, like right now, nothing's happening on this, so I'm just going to throw it out in the universe. Okay. I would love, love, love to see FHA change their policy on condos. Because right now we have some wonderful condo complexes in Central Phoenix, but nobody can get funding on them because they are mostly investor owned.
Yeah.
And a lot of those
50%
investors,
ratio.
and sometimes by one investor who
Yeah.
bought them for $1 in 2011. So they're never unloading those cash cows, right? So that's kind of doomed these complexes to always be mostly investor owned or
Sounds
cash
like
only.
See, right there, off you saying that type of thing makes me think, where are those? I should go look at those.
Well,
those
but
might
the
be
thing
get
is,
some
you
deals.
can't flip them to somebody who's going to get a loan. So you can only flip them to somebody who's cash.
Yeah, if you're a landlord, you're looking for more
As a
buy and hold
landlord,
at a discount.
Yeah, exactly. And so, and also you have to look at the condition. Oftentimes these investors don't like to increase their HOA fees because they want to keep their profits, but sometimes the maintenance of some of those can go downhill because they're not living there. See, so a little bit of changing could go a long way, but FHA, ever since that collapse in Florida of that high rise, has been very, very strict on the condition of the condos. So while I agree with that, I think they should do that. I think they should also say, hey, you know what? Maybe the condition would be better if we had fewer investors. And I can tell you, I'm sure lots of investors would be happy to sell those condos if they knew it was going to go to an FHA buyer, because they'll probably get more for it.
Yeah, then that's another
The
thing.
values would go up.
I have dealt with investors that they might get in a tight spot and they want to sell and they're struggling to sell. So it works many
So I
different
mean,
ways.
little changes like that could change your whole world in a second. You know, if lenders ever decided that these 3% mortgages could be assumed, I mean, our lives would change overnight.
So talking about policy, it made me think of one last thing before we wrap up. Mark Simmons, Zone Law, and Arizona Multi-Housing Association put together a list. There's 25 anti-landlord bills proposed next year. And basically they're saying if we don't vote properly, we can be the next California or Oregon in regards to the landlord-friendly state. Do you see any impact on our market due to those policies?
I haven't read those particular ones. Are they in the Arizona legislature or is it national?
This is all Arizona.
Arizona.
And they're
'Cause I know there's a
newsletter
national
this
one
month.
called the Stop Predatory Investing Act nationally that was introduced.
I think, don't quote me on this, he said that was the first time if Biden put that out, I think it was like the first time you ever saw the feds interact with rentals ever. It was interesting.
Well, I mean, I think we can thank Wall Street for that.
Yeah.
You know, and whenever our crazy rich
key
friends
point.
come to the marketplace, they mess everything up.
That's the key point, because I think it was like 60-70% of rentals, no rentals in Arizona are mom and pop landlords,
Yes.
AZREIA member. So it comes out of our kids' tuition or our retirement when these laws are made for Wall Street, right? So
That's right. And so I think that good representation would be, I mean, and I would say when I say good representation, I mean kind of a reasonable one, acknowledging that things got a little crazy, right? But not because of mom and pops.
Yeah.
But just because you have these now big players in the single family rental space, you know, with build to rent and all of that. I mean, they are a force, and you want to make sure that their activities don't impede. So what I've noticed is that the act on the federal level wants to focus on, entities or individuals who own a lot,
Yeah.
a lot. And now your definition of a lot and my definition of a lot
Yeah.
may be different,
Right.
but this is just where, and it's only been read on the floor. It's just a bill. Sounds Capitol Hill.
Yeah.
Right. Yeah. It's only been read, but at this point, they're looking at entities that own at least 50 single family specifically.
Yeah.
So if we can, and when I say we, I mean you, we collectively can give as much information to the legislature that they need to make good decisions. I think that's
Very true.
would be the most important thing to do.
So we got to stick together, Arizona
You
landlords.
can't just give emotional pleas. You have to have some hard, measurable data for them to make a good decision
So
in
true.
terms of any kind of regulation. But they've been beat up. I mean, let's face it. You had large companies coming in and buying up condo complexes and forcing people to sell and turning them back into apartments and pretty much kicking people out on the street.
Or when you're saying about the FHA, the hedge funds were coming in, first time home buyer couldn't even buy a house
I know.
because
Yeah.
they're paying above retail.
Absolutely.
So-
Absolutely. Right.
Yeah.
Exactly. So, I mean, those are the things that, maybe we should have some checks and balances on that type of activity, but you don't need to do blanket regulation on mom and pops. Or, in fact, when we were going through COVID, most of the single family operators in AZREIA who had single family home rentals were working with their renters during COVID, had almost no evictions.
I remember
happening.
like Alan would do the polls on Zoom.
Yeah, that's what
right?
I remember too.
It did not match the news.
Exactly.
Yeah.
So mom and pop people were not kicking people out on the street.
Yeah, that's so true.
They were working with their long-term tenants.
Because they have relationship with these things,
Absolutely. They know them, right?
versus the the large institutional buyers. You're just a number, you're a speck on a spreadsheet. So
Yeah.
that commonality wasn't there. So, and this is the reason why we need to be at the monthly meeting, right? Because Tina does the market updates. We have legislation coming in from Mark Zinman. All of these things are key components for us to stick together as Arizona investors to inform the public, to inform national, to let people know, that it's not just the big box or the big players, but it's us, the individual investors, that's affected also. So your voice is definitely needed and needed to be heard. So by attending the monthly meeting, it's
It's there.
Well, and it really helps me too. It helps me. I always learn something at the meetings because it's not just me, the speaker often. So there's usually I learned a lot from the water speaker because a lot of times my data, listening to them, I can put two and two together.
That's true.
If I learned that there was a large complex that could not get their water certificates, and I also knew from our own data from Michael Orr that Invitation Homes had just come in and bought an entire subdivision because they couldn't get their water certificate. So I'm like, oh, I know exactly what he's talking about now. So you can start putting the two and two together.
That's true.
And the thing is that water certificates are needed for builders to sell to the public, not to investors. So that's why Invitation Homes could buy that.
buy 'em, right?
Interesting.
I'm pretty sure
Because-
they bought that subdivision pennies on the dollar.
I know that I'm sure they got a really good deal.
Yeah.
I don't know. We'll see. I'm not privy to it. We'll have to see what it came out to. But
So before we wrap up, I know you were saying something about the changes affect outside and then come into the city center. You said Chandler is like one of the best markets here in the
it's
area.
the number one seller market right now. Yeah.
And why is that? Why do you think that is?
I think it had a lot to do with Intel expanding
Okay.
over there. It is in a very good spot in the Southeast Valley, well priced, and the product is good there.
Okay.
They have a diversity of product as well. You've got the north of the south part of the 202, and then you've got south part. I mean, and they also have, I just think they have an attractive
Okay.
area. School systems are good, all of that. So between Chandler and Gilbert was also right up there in still in market territory. But they also don't have a lot of new home construction.
Right.
So new home construction is what balances out a market. That's why Queen Creek never quite got into a seller market, but Gilbert did and Chandler did. Mesa was also in there, but Mesa also has new home construction.
homes,
So
yeah.
when you have that added supply in there, it just keeps
Balances.
it just keeps it a little more balanced, which is great for buyers, especially the incentives the builders were putting out there,
Yeah.
put resale sellers under a lot of pressure to offer the same things.
Cool. All right. So how do our members find you? How do they see you? How do they get access to the Cromford Report? All the above.
So here's the thing, the Cromford Report, all of our MLS-based stuff, only real estate agent members of the MLS.
Got it.
Of the Arizona Regional MLS specifically, are allowed to have those subscriptions. That's part of our data license with them. That's how we have permission to download all of their stuff every day. However, we do have Cromford Public, which is where all of the flip activity has to be done through public record. That's not an MLS piece.
Okay.
So our new construction, permitting, all of the flip activity, that's going to be in the public side. That is a annual fee of $240 a year.
Okay.
I believe it's 240, yeah. And in coming up, I am working on doing some videos. Actually, I'll do one right after this.
Okay.
I'm putting together a video library for subscription-based videos, which can be, anybody can have those subscriptions. And so I'm working on either a subscription for that or a pay-per-view option for that. And I'm sure AZREIA could have a coupon code for those.
I'm
But
excited.
I have to get my library together. So we're still working on those. Would not be live. They would be pre-recorded at this point.
Okay.
Okay.
I have not found a good live streaming product yet. So those, I think that product line is going to be really good down the line. Just 5-minute snippets of the market, focusing on different areas and topics that I get asked about quite a bit.
Cool. And you'll be with us in November.
Yes.
You'll be speaking at Venue 8600 in November with us at our monthly meeting on the second Monday of the month. It's going to be our 22nd anniversary as well. We always do something fun. We do giveaways, raffles with all our business associates. So come check out Tina in November or every other month here at AZREIA. Is it CromfordReport.com?
Yep. CromfordReport.com.
There you go. Perfect. Well, thank you, Tina. Always
My
appreciate it.
pleasure. Thank you.
Thank you. Another successful show.
Thanks for listening to the AZREIA Show with your hosts, Marcus Maloney and Mike Delpreet. We hope you enjoyed this episode. If you found this information valuable, head over to AZREIA.org and learn more about our community.